This conference will now be recorded.
And getting involved. We're specifically excited for KSL to be here because we actually have seen quite a bit of growth in our services category for plumbers and community. To give you an example.
Is it not working? I'll do it. My computer froze up, but that's alright. We'll get it to work.
But while we're getting that to work, KSL Classifieds and Services, if you've ever been on it, it's just a great platform for any person that wants to provide a service. You get on there. We've got quite a wide variety of people on there. We've got some large companies that come in, and that's their bread and butter. Likewise, we've got some great, wonderful semi-retired guys that just want to get some extra jobs during their off-season when they're a little bored. So we really do kind of help a lot of wide variety of service providers in the local area. And as you can see from here, we've got quite a bit of success over the past couple of years in regards to just people looking at the traffic. And in 2018, as we saw this increase with users, sessions, page views, people actually coming into the site, looking at listings, we noticed a large growth in leads that actually converted to that. In 2018, we had, between these two categories, about 15,000 leads go towards our merchants that were involved in. So there's lots to share, lots to get involved in. And luckily, as we come into 2019, quarter one, we're actually focusing on marketing on these two categories as well. So we'll see a lot of growth as we continue on in that. If you want to go on to that slide.
Yep. There we go.
So this is just a quick example of what it looks like. This is what a customer sees right when they open up your listing. We've got a great landing page to look at a bunch of different options. But as they open it up, this is what they'll see. They'll see the business hours, a brief description on what you guys do. And we also make sure when you put your info in, you can list where you're located so that you're not getting those out of service area calls or things like that. And it's a great way for you to show up in all the search results for those specific areas. So pretty basic, but what's great is that you can really make it your own. As you can see, you can add your logo and a lot of different options as you continue on. And then if you want to get that next slide. As these clients are scrolling through your listing, we want to add as much validation, make sure that when these users are coming on, we want to build as much trust as possible and for our merchants. And we found that reviews has been a great way to do that. Reviews, especially nowadays, 2019, that's pretty much how the online consumer shops. Is first thing they look at is they go to the reviews. And we try to make it as easy as possible for our merchants to be able to do that. All a merchant needs to do is have their listing URL that they can access both on the website or on the app, and send that to their customers. And the customers just need access to the desktop site and can review for your business. So that's been great. And as these reviews continue to grow, you'll see a lot more validation for your company, and hopefully what this brings is more quality leads to your listing. And if you want to put that next slide. This is an example of the reporting that we actually send to our merchants each month.
Oops, sorry. I understand.
We want to try to make sure that we have as much transparency as possible within KSL services. A lot of companies, if you had some experience, sometimes it's a little bit difficult to find out exactly where your leads are coming from, especially if you have multiple marketing facets, or even if you just do social media or Facebook, all that kind of stuff. This way, you'll know exactly where it's coming from. And luckily, we try to separate it out as much as possible. So if it's coming from our website, it's coming from our app, giving phone calls, texts, emails. That way, you can really kind of buckle down on what you want to focus on. And what I think is my favorite part of the reporting is to see how many people are actually opening up your listing versus how many people are calling. So then from there, we can work with you to try to see if you can get a little bit more catchy phrases and whatever it needs to try to get you a little bit more exposure that way too. If you want to put that next on. And then just briefly, some of the other features that we offer with those listings. You can create, if you want to run some deals, you want to try to help market a little bit there. You can create some custom coupons on your listing that you can have customers just quickly print out. Add a little bit more validation for your company on what you can do with photos and videos. And like I talked about earlier, you're probably using, if you're just trying to get some outside jobs out with your Facebook or website, you can tie all that in. All social media, all your websites, your email, and luckily that brings in a lot of, this makes KSL Services just a one-stop shop, which makes it really nice. And then likewise, if you are looking for that additional exposure, if you have your listing and you want even more leads coming your way, we offer a few more options.
I can't even understand it on the damn phone.
We can make that work for you. Likewise, if you got someone looking in plumbing supplies on KSL Classifieds, you can make sure that your ad shows up as they're looking for those things to kind of remind them we have to hire someone to do it instead. That's always nice. And then this is probably my favorite part is that we have a whole team dedicated working for you. If you do get signed up and you have a question and you email in, you're more than likely going to be talking to either Chad, Taylor, or myself. We're pretty tight-knit, close group. And then likewise, we've got developers that are constantly listening to what our merchants are giving feedback to. So 2019, we've got some great things coming out in growth as we continue on.
Question that has come up when I was at the DOPL meeting several months ago. They were going to try and keep those who are contractors, licensed contractors, to be the ones. Is there a quality check there to make sure they are a licensed contractor?
Right. So we do have an area for our merchants to be able to put in that they are licensed and put in their license number.
Okay.
Currently, it's not a complete requirement to have a listing on there, but that definitely stands out from the crowd. We make sure that that's at the top of the listing so that they can see, this person is licensed and have the ability to go validate it and take you to the state website to make sure that that's the case. So yeah, that's a great question. We do get that a lot, and we want to make sure that we cater to that as much as possible. And then if you want to put that next slide. Great question. Is there any other questions so far as I've kind of talked about this a little bit? Okay. So in regards to how it all works, it's fairly easy. You can actually go online right now and start playing around with your listing, figure out if it's something that you'd like to get working on. And if it is something you want on our site, it's $45, and then that just gets billed monthly to have the listing up on the site. And then after that, it's just $1 for every instance of traffic that you do send your way. So that's, of course, with phone calls, text messages, and that's a website business. That way, we do keep this in regards, again, if you've been with Thumbtack, Angie's List, any of those guys, we've made ourselves very competitive in this market, and the lead value we try to make sure is competitive with what you see as you compete with other companies. And then, one last slide. And then to get up and running, you can, again, like I said, you can go on the website, just highlight all the services, click add a listing. We've got some great content you can follow and get to that. But if you do have more questions, if anything that we talked about today kind of spurred some interest, or if you want a little bit more clarification, we've got 4 great guys that work throughout the day, our account executives, that actually work with you from start to finish throughout the process, as well as give you all those options.
How do you do your Telegram and text message?
So
for conversation or text?
Yeah, great question. So it's for the conversation that comes in. As you talk with your clients, you'll notice as they come in that your number that you see on the list is a tad bit different. That's how we track everything. Is we assign you an attachment that you numbers, and then with those we absolutely just come out to make that as seamless and as easy as possible too. But yeah, so that phone number on there, feel free to give it a call. Likewise, we'll be seeing you guys again in March. We'll be coming down for the conference down in St. George. Any questions before we wrap up? All right, fellas, again, thank you so much for your time. It's great being here.
Thank you. Thank you. Like I said, they're a platinum sponsor, and we appreciate very much their support of the association. And I know that you all are saying to yourself, we don't need any more work right now, but there will be a time that things will slow down, and you're going to want to have some other alternatives in your marketing program. So anyway, that's a good possibility there. Just a second, let me get the other PowerPoint up. While I've got the focus of everybody's attention, just a reminder that we have the conference coming up on March 28th and 29th in St. George, and we're excited about what we have planned there, and would hope that you would consider strongly coming down. This is probably the most aggressive and largest conference we've done thus far, and we're excited to be a part of doing that again. So we're just wanting to make sure that everybody. Do you have the clicker?
I do.
Okay, and I'm hopefully the clicker will work now. And so please plan on coming to St. George. Like I said, that's going to be a great conference, and you've received emails in regards to that, and we'll continue to send those out. We appreciate very much Steve being here with us, and that's still not working.
Clicker's not working. You got it? Yeah, you got triple A's on it?
Here, let me.
That'd be amazing. That'd be great if you did.
Okay, just tell me when you want me to turn the thing, and I'll do it.
Okay.
So, Steve, we appreciate very much. They're another one of our great sponsors of the association. And Steve, we appreciate you being here. And this is kind of a an annual type of thing, and we're excited to have you here. So we'll just turn the time over to you.
I'm as excited as you can be about taxes. You know, how long have you been the executive director?
4 years.
4?
Uh-huh.
Okay.
Going into the 5th year now.
So this is about probably the 5th time I've done this presentation. And there's always something exciting going on, especially this year. You might have noticed, or you will notice, hopefully, when you get your taxes done, that there's some new things. And hopefully, for all of you, you know, we all spend a lot of time managing our labor, managing our materials, making sure our vendors are taking care of us and paying us, and we're paying the right amount for our materials. But taxes are probably the number 3 expense. If you're making money, taxes are probably your number 3 expense, if not higher than that, depending on what you do. And hopefully, you're spending enough time on your taxes. It's not that taxes are optional, but there's a number of strategies and really understanding this new tax law that changed about a year ago, changed at the end of 2017, and it was all effective in 2018. Well, we haven't done the tax returns yet for 2018, so there's still some complexities that we've got to work out, but there's a huge number of opportunities, and especially for contractors with these new tax rules. So I'm going to talk about some old ones, some new ones, and just kind of a quick summary of contractor tax an update. So, Dave, hit it. Yeah, this was back a little over a year ago when they started changes that they squeezed in right at the end of 2017, and that was kind of one of the, we kind of find this to be somewhat comical now, that they talked about a postcard and making everything simpler. We've taken, I've been doing this a long time. This is probably the biggest tax change that I've ever experienced in my career. There was one in the 80s that was similar, but I wasn't doing this then. So
Did it simplify it or make it more complicated?
Exactly. Complicated by about 3 times. There's all these little nuances, and we'll get into some of those details. But yes, much more complicated. That's why this is a comical photo. So, Dave, hit it.
Sorry.
Okay, you hit it again. And again. We'll talk about businesses first. And maybe just kind of scroll all the way down. I've got bullet points that kind of show up, and if we should probably keep things moving.
Okay.
Bonus depreciation. I mean, you know, for contractors, there's only a few deductions that are really good and that everybody should take advantage of. And one of them is obviously depreciation and accelerated tax depreciation. One of the bonus depreciation has been around for a while, but in 2000, is it working now? Yes. Oh, great, thank you. In 2018, bonus is now 100%. So if you have $100 million worth of equipment that you buy in 2018, you can depreciate it all, the full cost of that equipment in 2018. It's unlimited. It's 100%. It could be new or used equipment. So it's basically wide open. Whatever you buy in terms of equipment, you can depreciate. You can finance the equipment. You don't have to pay cash for it. Tremendous tax planning ideas. Now, you have to put it into service before December 31st to get the deduction. So it's a little late now to squeeze something in, but this goes on all the way to 2026. So really, I mean, if you're not doing this, I mean, we sit down with our clients at least annually, and especially at the end of the year, we kind of plan, okay, do you need some equipment in the next 3 to 6 months? We'll buy it in December and put it into service, and let's get the tax deduction and let the government help us pay for some of that, or at least the cash, help us save some of the cash, because that's just that much less you have to pay in April. Section 179, another type of depreciation. Again, it's been around for a while. The limits went up. It's just another opportunity to deduct additional equipment costs. They've also liberalized some of the other rules for Section 179, and applies to some HVAC and alarm systems, things like that in a building. So if you improve your property, you can deduct the full cost of some of those things in the year that you bring it into service. So again, some great depreciation rules. Autos. I mean, I don't know how many of you have cars in your businesses, but, you know, in the old days, you buy a car, it would take basically, you know, 30 years to depreciate it out because it was very limited to what you could do. Trucks and equipment like that, you can depreciate the whole amount, but cars were always limited. They've increased that now, so it's quite a bit more aggressive, and you can deduct $41,000 worth of a car in the first 3 years, as compared to it used to be 11 grand.
But it's got to be like a 3/4 ton or something or bigger.
Oh no, this can be a car. This is a car.
Any car.
Any car. Yep.
No, I thought there was a line.
Well, there's different rules for a sport utility SUV, but anything over 6,000 pounds, you can take that bonus depreciation under Section 179 and get the whole thing.
So 6,000 pounds is an any car, though.
Well, right, but that's what I'm saying. That's a truck. But these are everything else that doesn't fit into those other categories of an SUV or an over 6,000 pound vehicle. So again, liberalized a little bit. Other changes, you know, you used to be able to trade in equipment for other equipment and not have to recognize the gain. Well, they changed this now. You can only do a 1031 exchange, which is a rule where you can trade it. You only do that for real estate. It used to be you could do it for real estate and for equipment. But now they changed that. So what you have to do is recognize the gain on the trade-in value on the new piece of equipment. And then, well, if you get another one, then you can deduct the whole thing. It kind of is a wash, but it can be a little painful if you're not paying attention. It can result in some taxes a little bit differently than it used to be in the past. And then, like I said, the expensing can offset everything. And here's just, you know, some basic rules of depreciation. 39 years is the typical depreciation life for taxes for a building. 27.5 years for residential, you know, apartments or a home. And 15 years is, again, for improvements that you might do to those buildings. But one thing that we've done a lot of these with our clients is a cost segregation study, where you can basically look at either an existing building that you've owed for a number of years, or if you have a new building, we look at the plans, we figure it out engineering wise, and we break out a lot of that building. You know, say you have $1 million building and you're depreciating it for 39 years. Well, that's like $40-something thousand a year with the depreciation for 39 years. We come in, look at it, and we can typically get between 20 and 30% of that building, or $200,000 or $300,000, can be in shorter life property, like 5-year or 7-year or 15-year, and it can just front load the depreciation on a building, which can be really good. We've got a number of real estate investors and a number of contractors that have buildings and real estate, and we've done these, and again, when they're making money, like hopefully now, it gives them a chance to get some real healthy deductions. Business income. Okay, we're getting into some of the new laws. The old law there used to be something called the domestic production activities deduction, and if you're a contractor, you should see that on your tax return. It's not available anymore, but it used to be 9% of the taxable income that you had from your construction business. Okay, I mean, there was some other calculations, but just basically that's what it was. The new law, the DPAD, was repealed, and now there's a new 20% pass-through income called the qualified business income deduction. And so the 9% goes away, and then you get the 20, so it's a net of 11% typically. But there's a bunch of restrictions and limitations and complexities that tie into that. And it goes kind of like this. Okay, here's DPAD again. Here's the new deduction. 20% of your taxable income from your construction company. It's also got some rules with different types of businesses that are not allowed. But basically, you take 20%, say you have $100,000 in taxable income from your construction company, you would take $20,000 as a deduction and basically pay taxes on $80,000 in that example. But it is limited to 50% of your wages that you pay out of that company, or if you're a real estate holding company of some sort, it's 25% of wages. Well, if you've got an entity that holds a building, you're not going to probably have W-2 wages in it, but you can take 2.5% of the cost basis of that property. So in that example I gave before, you have a $1 million building. Say you make $100,000 in taxable income from renting that building to your construction company. You would be able to get potentially a $20,000 deduction. Well, that's limited to 2.5% of the cost basis of this $1 million building that you bought a number of years ago. You'll have $25,000 of that, so you can take the $20,000. If it was, say, a $500,000 building, you'd only get $12,000. You would limit your deduction from 20 to 12. Okay, just some little things, but you've got to be careful and you got to pay attention as to how to do this. And we've done some things with, moving entities around so that they can take advantage of this deduction. I mean, this 20% deduction is significant, and it's just sitting there on the table. If you don't fit into this and you don't plan, you don't get it, and it's gone. You're paying more tax than you need to. So something to think about. This is very important, and it's going to continue for basically indefinitely. It's going to be a part of our lives in terms of taxes. And then just some other special rules with how you define what that 2.5% of the property is, but significant. Then some other details: meals and entertainment. Basically, you used to be able to deduct 50% of things like jazz tickets. You can't do that anymore. It's zero deduction for entertainment, straight entertainment. Okay. Now, if you have meals or something in combination with that entertainment, you can deduct 50% of the meals, but the actual tickets themselves, or if you're entertaining your clients or doing something in that area, you can't deduct it. Business meals, per diem is again only 50%. Meals for the convenience of employer are fully deductible. So Christmas party for your employees would be 100% deductible, or if you bring food in so that people can work overtime, that would be 100% deductible. So there's some just new nuances with entertainment. Interest deduction limitation, this is also a new thing. If you're less than $25 million in revenue, you don't have to worry about it. But if you're over that, then you have to really watch your interest deduction, because you can only deduct 30% of your taxable income in interest. So if you have more than that, if you're very leveraged, you have to be careful, because you won't get a full deduction for the interest. And it's carried forward, but it carries forward, and those rules apply every time. We've got a few clients that are really leveraged, and we have to watch this. They could lose some of the deduction for their interest. This is an exciting one, and I don't know how many of you are on the cash basis for taxes, but
Changing this year.
You are changing. Oh, good.
This year.
Okay. Basically, it used to be that if you were under $10 million in revenue, you could use the cash basis. Okay. If you're over 10 million, you have to switch to the accrual. Okay. They changed this now so that if you're up to $25 million in revenue is the new rule. So likely that's why you changed to the cash basis, because you can now. And this is significant. We've probably done this with 10 or 15 of our contractor clients this year that fit in that window, because it's like, gee, why not? It's huge. And then there's also some other methods that have now been liberalized with that revenue increase, and that's the completed contract method, which again I used to do with all my clients because they were all under 10 million. Now they're all over 10 million, and they couldn't be on the completed contract method anymore. And basically that means you don't pay tax on the income from jobs that are still open. If they're open at the end of the year, you don't pay taxes on them until they're complete. Okay. And again, another way to just kind of push those taxes down the road.
What's the rule over 25 million?
Well, then you have to go back to accrual.
Just accrual. Okay.
Well, there's other methods. There's one that we're working on with the client where if you do a lot of residential work, there's some little things that you can do to defer residential jobs over 25 million. But those this is what's called the cash basis change. It's called an automatic change. You don't have to fill out this big form and pay all these fees to the IRS. But this other change, it's called the 70-30 method with residential, and it's like $8,000 fee you pay to the IRS, and they have to sign off on it, and it's a big deal. But for this client we're doing it for, it's going to save them a lot of money. So there's a lot of things, if you are on the accrual basis, if you are on the tax basis, just understand that especially for contractors, there's a whole lot of different ways to skin a cat and to pay your taxes and to recognize income, and you need to have somebody that knows what they're doing, rather than just putting numbers in boxes. And hopefully that's what we like to do with our clients. We do probably 60% of all our clients are in construction, so we know this stuff, and we are definitely looking out for you in a lot of ways. Always. C Corporation, you might have heard that tax rates for C Corps, which is again a C Corp, pays taxes at the company level. The tax rate was lowered from 35% to 21%, so that's very, very low. Again, you still have the problem with the C Corp, where if you have to get money out of the company, you have to pay taxes again. I think there's an example here. Let's see. There we go. So the company makes money. Say you have $100,000 in income in your C Corp. You pay $21,000 in taxes at the corporate rate. So that money's, again, still locked up in that C Corp. You can get the money out by paying a dividend to yourself, but then you got to pay 15% tax on that. So it adds up to 36%. Right now, the highest individual level is 37%. But if you can take advantage of that 20% deduction, well, 20% of 37% is 7.4%, and you subtract that from the 37, so you can get your rate down lower as an individual. Still makes sense. I mean, we probably have 97% of our contractors are either S corps or LLCs. They're not C corps. But we have talked to a few of them about some of their other entities, and we have converted some other S corps to C corps.
S corp's the same thing as this?
Same thing, yes. Well, the on the bottom.
On the
The
bottom.
flow through, yes. Right,
Okay.
right. That's where the 20% business income deduction doesn't apply to C corps, but they just have a lower rate. So I mean, that was a significant change. I mean, you know, these big public companies that are making billions of dollars, they just got, you know, hundreds of millions of dollars in tax savings just by the way they're doing it. Yeah, they're C corp, and that's what all those big companies are. But it still can make sense for certain situations to be a C corp. So it's just something to think about. Gift and estate taxes changed a little bit, basically doubled the exemption. Might be a benefit to some of you. And then some individual tax changes. We'll talk about those. And here's this one of my favorite. Yeah. What's your status? There you go. I'm number 3, and no, I'm number 3, and I do this for a living. Nah, I'm probably just number 1. I still have fun with this stuff. But it's there are just some huge changes, and basically one of the things we do when we plan with our clients is we really try and plan for the tax brackets, okay, so that they're paying tax at the lowest rate possible. Now, all the tax rates change. This is the 2017 rates, but we can talk about, here's kind of a change, a side-by-side comparison last year to this year, and going forward, you know, rates went down. Rates went down considerably. Now, there's other things that I'll talk about in a minute that are going the other way that may hurt you, but basically overall, whether you take advantage of that 20% or not, everybody's going to be paying a couple percent less in taxes in 2018 as they were in 2019 or 18 and 17. Here's kind of an interesting comparison. I don't know, there's a lot of detail here, but basically everybody, as you can see on the effective tax rate in 2018 compared to the effective tax rate in 2017, every bracket is paying at least a couple of percentage points less in tax. So that's all good. That's all good. But unfortunately, there's some other traps. Capital gains rates didn't change. Everything's the same. One thing, you know, we try and do with some of our clients that are making less money, or retired people, we try and get their capital gains to be, I mean, if you're married filing joint and you have $77,000 or less in taxable income and a bunch of that is capital gains, you pay no tax on your capital gains. It's 0 is your rate. So if you're retired and half your income is capital gains, you can, but if you're over that, if you're $1 over that, then you pay 15%. So we've had a number of cases where we said, no, don't sell any more securities or sell some losses that'll offset those to bring your capital gains down so that then you pay 0 tax on your capital gains. So a little trick there. And then if you do make more than $250,000 married, there's a 3.8% net investment income tax on your portfolio income, your investments. You don't pay that on your business income, but on your investments, so something to watch out for. And then standard deduction changed, so less people will be itemizing, and maybe this is what they were saying when they were talking about the postcard, that, oh yeah, less people are going to have to itemize and keep track of their charitable contributions and their interest and all this, because the married filing joint, as you see, It used to be 12,007, which means you need to have more than 12,007 of interest and property taxes and charitable contributions to be able to deduct it. Now it's 24,000, so a lot less people are going to be itemizing their deductions, which can be kind of a pain. And then personal exemptions used to be for you and all of your dependents each, you had another $4,000 deduction. Well, that's gone. So things are a little bit different. And this, the top part there is better for taxpayers. The bottom part is worse. So it kind of depends on what your situation is. And then the child tax credit was liberalized. Now it's a lot more, and it's not limited, or very, make under $400,000, and you still get the.
Now all my kids are going.
I know, it's right. Isn't that great? And yeah, isn't that great?
I've been so mad about that one.
Well, just get some more kids. I don't know.
That just sucks.
Get some non-child dependents. You get 500.
Yeah, right.
Oh my God.
Or bring your parents in to live with you and get a little something extra there. Yeah, get a $500 deduction. That wouldn't be worth it for my parents to live with me. $500 would not even be close. But
Keep them in the home, huh?
Yeah, right. There you go. And then, this is the one that really hurts. We have a number of clients that pay a lot of state taxes, and this is why all the people in California and New York were pissed, because now you cannot deduct. You can only deduct $10,000 worth of state taxes that you pay. So some of these, you live in New Jersey. Do you have any idea how much your property taxes are? They're like $20,000, for a starter home per year, and you can only deduct 10 of that on your federal return. We've got some clients that make a lot of money and they pay a couple $100,000 in state taxes. Guess what? They're losing $190,000 with the deduction compared to last year. So this is the thing that goes the other way. And this one can be really painful if you make a lot of money.
Anybody do that?
Anybody do that? Yes, a number of people did. This one really hurts, and not much you can do about it, depending on where you live. Utah has fairly low state tax rates. Our state tax rate is 5%, compared to California is 13.7% is their highest rate, and New York is like 12. Hawaii, it goes up to 18 in certain brackets. So some of these states, and that's why they're trying to restructure their whole way of doing taxes, or the way of collecting taxes and calling them taxes. I think it was New York that threw out that they were going to call them charitable contributions. When you pay, it was something where you're contributing to the schools or something, and that you get a credit on your tax return for doing that. And I don't know. We'll see how that. I think that didn't fly.
I just don't know how that one.
But they're working on some of that stuff. But yes, so just mortgage interest changed. It lowered. So now you used to be able to get your mortgage interest deducted on 1.1 million of debt. Now it's lowered to 750, and now there's no home equity loan deduction anymore. And a lot of us have home equity loans that we used to deduct the interest. Can't do that no more. So it might make sense to refinance your house and put it all in your mortgage instead of having a home equity loan. So some little tricks. Second home, if you have that, you have interest there, you can still deduct that. And then if you do have a loan before that, that's 1.1 million or over 750, you can still deduct it. Individual deductions. Well, charitable contributions, not a big deal, but again, because those standard deductions went up to $24,000 for a married couple, it might make sense for you to do group your charitable contribution, make 2 years per year and double it up so you can deduct it, and then the next year you stiff your charities, just so that you can get the tax deduction. I'm sure.
Explain that again. How do you do that?
Well, you just pay 2 years worth of charitable contribution in 1 year.
You mean this year?
pay it all in 1 year, and then don't pay any next year, and then the next year pay double, and the next year pay none.
So the reason for that is what?
It's because the standard deduction went up to $24,000. So you have to have more than $24,000 worth of, $10,000 worth of taxes, state taxes, your charitable contributions, and your mortgage interest have to be more than $24,000 total.
Okay.
If they're not, you don't get it. It doesn't matter. Everybody gets 24, even if they don't have a mortgage, they don't have any charitable contribution, they have no state taxes. They still get a $24,000 deduction.
So you're saying pay
you want to
double.
clump. You want to clump it. So you get over the 24,000 1 year. The next year you'll be under.
Well, I'm over here.
Okay. Well,
Sorry,
it's just a it's just a planning.
But would it
thing.
help you, even if you are over the 24, to do it double?
Well, if you're over, it wouldn't help. If
Really?
you're under or you're close, it would help to group it. If you say you give $10,000 a year, and plus you have other deductions, 1 year you would have 35, and the next year you'd have 20. Well, you'd get 24 in the year you got 20. You wouldn't get any benefit for that charitable contribution. So just again, it's a game. Well, whether it's worth it or not, but we've got some clients that it made sense for them to do that, is to clump things because they were really close and they weren't going to be over if they were $22,000 a year every year, and then but if they did it $44,000 in 1 year and zero the next year, they'd get the bigger deduction in the year that they doubled it up.
But you still get that 24.
Yeah, right.
Whether you had any or not.
Correct. So if you're close to going over, or you're just barely under, it would make sense. Alimony, it made sense to get divorced last year, and maybe not so much this year, so you're too late. You have to stay married. Right.
Not a good year.
Yeah, right.
Just missed that one.
You just missed that one. Right. But yes, so that was an interesting change. Okay, any questions about any of this fun stuff, tax stuff?
I've got a question about, I don't know how much you looked into.
You drive a lot and you're deducting miles
Oh,
as an individual.
yeah.
That's killer.
That's another problem, yes. There's no miscellaneous itemized deductions anymore. So it's virtually, you'd have to drive an awful lot. To get more than $24,000 worth of miles, yes. Well, but you could maybe think of another way to do it. Can your employer reimburse you and run it through the company?
Next year, not this year.
Okay, okay. That's what I do. I just run it through the company and see if the company's reimbursing you. Yeah.
The next year we'll do it.
Okay, okay.
Okay, if there's anybody online that has any questions, you're welcome to, I've unmuted your mic, so you're welcome to ask any questions. Everybody's dead.
Okay. Well, yeah, one other thing I want to touch, just to kind of change gears a little bit, and Dave sent out an email to all the membership earlier in the week about our wage and benefit survey, which we'll be taking survey responses for about the next 2 weeks or so, and then we'll close it. I've got copies of last year's. This is a year old, but this is exactly what we're going to be doing this year.
It's a great survey, and it's oriented towards the construction. So if you're looking to see if you're competitive or if you're whatever, it's participate. That way you get to receive a free copy.
You get a free one, and you make the information better. I mean, that's what I appreciate more than anything else. It takes 15 minutes, 20 minutes to fill it out, and it's a really good report. And it's got about 30 different job categories with details, and the average versus what it was last year. And obviously wages are going up, but it's interesting to see kind of what goes up more and what doesn't go up as much. Yeah, it's David.
Who's got the work to do those?
Right. Right. Dave, can you just advance this?
Oh, you still had some stuff
There
there.
we go.
Sorry.
Yes. Couple other slides just with,
Sorry.
yeah, it's kind of small, but this is one page of our report last year that shows a lot of the different job categories, and we usually get a huge response from plumbers. So we have a good sample of plumbers. We probably have, I think as of the other day, we've had about 120 respondents so far from Utah. Not all plumbers, but it's a good sample. We typically have 200 respondents a year. And so if you haven't, I know a number of you here in the room have, and we appreciate that, but definitely if you can do that, that'd be great. And Dave sent the email to everybody the other day. If you need one, send it to me. I'll be glad to send you a link to do that. And yeah, so that's it. There's my contact info. I've got these copies of these if you want one from last year. You just kind of pass those around. All right. Thank you very much.
Thank you very much, Steve. We appreciate it very much.
Where are you out of? Salt Lake City, Midvale.
You take new customers?
I do.
You refuse to be a customer.
Yeah, no, yeah, right. Here.
No,
They were paying the bill.
Yeah, right. No.
they have been
Thanks, Steve.
very helpful in years past. They have used them for many, many years. So we appreciate it. Used to be Leverage Group, and something in between now.
Yes,
CLA.
and now CLA for the rest of yes.
And they're a great sponsor. We appreciate very much the KSL Classifieds coming, our diamond sponsor this year, and like I mentioned, CLA with Steve being a mixed up sponsor as well. Many of you are, and we appreciate it very much. Once again, I just want to remind you of a couple things. St. George, March 28th and 29th. If you haven't signed up for that, please do. We're excited about that. We have some great presentations. I'm really excited about this year. Also, this recording will be posted hopefully tomorrow sometime, and I'll send out an email so you can listen to it again. Or if you have someone in the office that you want to have listen to the presentations, and also download the slides as well. So we appreciate it, and thank you very much, and we'll see you next month.
Thanks. Yeah, of course.
Yeah, very much.
And I'm trying to see if I can get
Oh,
yeah, cool. Thank you.
Pretty busy last night. I feel it was down like.
Not this year, but
what's the guy's name?
George. Yeah, he's good.
He's great. Is he really expensive?
He's really giving us a good deal. There's a couple of members that are
doing his
thing.
That's great.
Yeah. So we're excited about that. And